Have you ever wondered what the absolute worst case scenario in trading really looks like? I'm not talking about just losing what you put in. I'm talking about a single, simple mistake that can spiral into life-changing, catastrophic debt. Well, today we're going to stare right into that nightmare. Okay, just imagine this. You're a retail trader. You open your email, and this notice from your broker pops up. It's a physical delivery of crude notice. It says you are now the proud owner of 2,000 barrels of oil. That's 84,000 U.S. gallons of West Texas Intermediate crude. And here's the real kicker. It says you need to arrange for pickup from a storage facility in Cushing, Oklahoma by 5 p.m. today. Now, let's be honest. You don't have a fleet of tanker trucks ready to go, so you can't. What happens then? This, my friends, is where the uncapped nightmare truly begins. So how on earth does someone end up in this situation? How do you accidentally get assigned a convoy's worth of oil you have absolutely no way of handling? It all boils down to a fundamental misunderstanding of what you are actually trading. It all starts with this crucial concept: physical settlement. You see, when you're trading WTI crude oil futures, you're not just playing with numbers on a screen like you would with a stock. You're entering a legally binding agreement, a promise that if you hold that contract to expiration, you are taking delivery of the actual physical flammable crude oil. The road to this disaster is paved with three critical errors. First, you held a long position, meaning you bought the contract expecting the price to go up. Second, you just didn't sell it before the expiration deadline. And third, you failed to roll it, which is the standard practice of selling the contract that's about to expire and buying a new one for the next month. You just held on too long. Now, I have to be super clear here. This is an extreme edge case. Most modern brokers, including Interactive Brokers, have all sorts of automated risk systems specifically designed to stop this from happening. They'll usually force sell your position before it gets to this point. But for us to really understand the immense risk involved, we're going to explore what happens if those safeguards fail and the worst case scenario plays out. So, the moment of default. The deadline has passed, you haven't picked up your oil. Now what? Well, a clock starts ticking, and it's your broker's money and reputation on the line, not just yours. It's an emergency. And here's the reality of the situation. The exchange, whether it's the NYMX or the CME, they honestly don't care about you, the little retail trader. Their contract is with your broker. Your broker guaranteed the trade, so when you default, it's your broker who's on the hook, and you can bet they're going to pass every single cent of the fallout down to you. So what's their first move? The broker's risk management team immediately seizes control of your account and everything in it. They have to get rid of that oil, and they have to do it now. They launch what's known as a fire sale, desperately scrambling to find a big commercial buyer who can actually take delivery. And that buyer? Oh, they can smell blood in the water a mile away. We're talking about a serious amount of value here. Depending on the price of oil, those 2,000 barrels are worth somewhere in the neighborhood of $200,000. But because your broker is a distressed seller operating under a time crunch, they're going to have to sell it at a huge discount, and you are responsible for making up that difference. You think that loss from the fire sale is bad? Oh, that's just the appetizer. Now comes the truly terrifying part. A full-on avalanche of punitive fees and penalties designed to make an example out of you for screwing up their market. First up, you get hit with counterparty damages. The person on the other side of your trade, who was supposed to deliver the oil, had everything arranged. You broke the deal and caused them a logistical nightmare. For that, the exchange makes you pay them. That's $5,000 to $20,000 right out of the gate. Next up, the distressed liquidation deficit. Remember that fire sale? Let's say the oil was worth $200,000, but your broker could only get $150,000 for it in their panic. Well, you owe that $50,000 difference. That's another $20,000 to $60,000 just vanished. After that, the exchange itself wants its pound of flesh. The NYMEX and CME will levy absolutely massive fines for breaking the delivery rules. These aren't to cover costs, these are purely to punish you. You can expect to see a bill for anywhere from $25,000 to well over $100,000. And just when you think it can't get any worse, it does. Your oil is now physically clogging up critical infrastructure. It's sitting in a tank it shouldn't be in. For this, you get hit with astronomical daily storage and demurrage fees. We're talking $10,000 to $20,000 per day until that oil is finally moved. This penalty alone can rack up over $100,000. So let's just put this all together. You've got the loss on the oil itself,
The insane daily storage penalties, the huge exchange fines, the damages to the other party, and of course, your broker's own administrative and legal fees for having to clean up your mess, it all just stacks up with terrifying speed.
So after the dust settles and all the financial carnage is tallied up, what does that final bill actually look like? This is where a simple trading mistake officially ruins your entire financial life. Let's walk through the math real quick. First, your account gets debited the full value of the oil, say negative 200 grand. Then the fire sale brings some of that back, crediting you maybe 150 grand. So your net loss just on the oil is 50 grand. But the final, devastating bill is that $50,000 loss plus that whole mountain of penalties we just saw, all stacked on top. This is the number that should keep you up at night. The total estimated debt you're on the hook for ranges from $82,000 to nearly $300,000, or even more. And let me say this again. This is on top of losing every single dollar that was in your trading account to begin with. Your balance doesn't just go to zero, it goes deep into a negative abyss. And now the consequences spill out of your trading account and into your real life. The broker will immediately liquidate any other assets you have with them, your stocks, your bonds, anything to try and cover the debt. If that's still not enough, their legal team will sue you, and they will win. They can get a court order to garnish your wages for years, maybe even decades, until this massive debt is paid off. One source put it perfectly, and it's this. You don't just lose the money you bet. You incur massive, uncapped debt. So if you take one thing away from this entire explainer, please let it be this. With physically settled futures, the real risk isn't just losing the money you put into the trade. The real soul-crushing risk is ending up owing more money than you ever had in the first place. This is a nightmare scenario that, frankly, a lot of traders don't even know exists. So if you found this explainer valuable, please do us a favor and like it. The more people who see this, the more traders we can warn about this absolutely catastrophic danger.